financial markets, assets, and institutions, which are components of the financial system. Now we need to look at one of the components, the remaining component of financial system, which is financial regulation. In order to tell there is a regulation, or to say there is a regulation, there should be a regulatory body who controls and regulates the financial system. Also, there are different financial market participants in the financial system who are regulated. So let's look at who are the financial market participants. This could be a pure investors or speculators. But do you know the difference between investment and speculation? Just to make you understand the concepts deeper, let me look at the difference between investment, speculation, as well as gambling. These three terms have something in common because all three of them looks like spending your money in order to get some return. It looks like that way. However, there is a difference between investment, speculation, as well as gambling. So what is the difference? If it is an investment, it is done by expecting most of the time a long-term return. If you are an investor, you require a long-term investment return. However, speculators are the one who bought anything. It may not only be a financial asset. However, they bought anything when the price drops and sell it again when the price raises. So they are benefited from the price fluctuation. Speculators or speculation is buying something when the price drops and selling it again when the price rises in order to be benefited from this price fluctuation, and the difference will be the return. However, gambling is the shortest return provider. If you get a return from gambling, you will know in the result immediately. So if you invest, probably you might need several years in order to know how much your return is. For speculation, it's a bit shorter. However, in gambling, you might immediately know whether you get it or not. For example, a lottery ticket. The other difference is in investment, the return is usually in different ways because you have different opportunities of investments. However, for speculation, the return is in the form of price fluctuation. But in investment, there are different investment avenues. There are different investment opportunities. So in different way, you can get a return, not only in the price fluctuation like in the speculation. Hence, investment is long term, and people most of the time get in investment by making detailed analysis, so that investment is a little bit less risky than speculation. However, in speculation, you have a shorter time. You might buy some commodity or asset when the price drops. However, if the price doesn't raise up again, even you might not be benefited at all. Also, there's a probability that this price might drop further. So speculation is more risky. We know that gambling is the riskiest one compared with these two. Investment considers the fundamental factors. Fundamental factors means there are two different analyses. I will not get deep into it, just to tell you that this one requires more time than this. So when you make a technical analysis, what you analyze or study is that you look at the trend. For example, if you want to buy the one company's share, what you have to do as a technical analyst is to look at the past share price history of the company. So in the past, if the company has a good history about its price increment, so you will look at this trend and you probably estimate the company's share price will continue to grow for the future years also, and you will consider the company as a growing company. You will not make any additional further deep analysis like this fundamental analysis one. Just you look at the price history and predict the future price. If you found the company will grow, you will buy the share based on the prediction you made from the past data of the share price. However, in fundamental analysis, you have two options to make EIC: analyze the industry, the economy or the macroeconomy of the country which the company is in, the industry which the company is working in, and looking at different factors of the company other than the share price history. For example, when you analyze the economy of the country which this company is working in order to choose it from other companies that are operating in abroad as an international level, you look at these different The type of bonds that we have talked earlier, probably you might find the name. Fundamental analysis, one of the components is economic analysis. Economic analysis is analyzing the macroeconomic of the country. But why? Why do you need to spend your time analyzing the whole country's economic status just to invest in one country? The answer is simple. Because in the world, if there are two companies, think of it, one is found here in America and one is found here in Afghanistan. Probably both of these companies might have the same potential, the same capital. However, for you as an individual investor, it's better for you to invest in the company who is in America rather than who is in Afghanistan, because the risk is minimized when you invest in a country that is stable and growing. It's less risky, so it's better to look at every country you want to invest your money on before looking the specific company in that country. So in economic analysis, you might look at this different factor. One is GDP. If the GDP means the total number of products produced in that country. If it is high, it's probably best to choose the company you invest on in that country rather than any other country. If the company has a growth, if the country is growing country or has rapid growth, it's better to invest in a company that's present in this country. The other one is trend in public investment and saving. This is more related with interest rate. Let us look at two different scenarios. You know that there is something called the bank borrowing rate and bank lending rate. What's bank borrowing rate? A bank borrowing rate is what a bank pays you when you deposit your money. When you deposit your money, you are lending the bank, and the bank is borrowing your money. So the interest payment that he made on your deposit is called bank borrowing rate. However, when you take your money, when you take the bank money, when you borrow from the bank, you will pay the interest. From the bank's perspective, it's lending activity. The money the bank gets from lending his money it came from the bank lending rate. So bank lending rate is what the bank charges you when he lends your money, his money. However, bank borrowing rate is what a bank pays you from your deposit. So let's look at a scenario when the interest rate drops, which is a bank borrowing rate is 10%. You get 10% from your deposit, or the bank lending rate is 12%. You will pay 12% for the bank if you borrow. A bank, and one scenario is when the interest rate goes up. We'll talk in both scenarios what will happen. The first one is when the interest rate drops. What if it is 10%? As an individual, what will you do with your money if the interest rate is too low, like 10% in the country? Because we are looking from the macroeconomics. This means every bank or most of the banks lends you with 10%. Pays you 10% on your deposits in that country. This may differ from country to country. For example, in this country, probably most of banks pays 10%. However, when you came in this country, most of banks might pay 20 or 30%. So what would happen if the interest rate drops? As an individual investor, think of it. Most of the time there is a higher probability that the investment will rise and saving will decline. The reason is, if you have a money, you don't want to deposit your money in the bank. Rather, it's better for you to invest in any other investment, because you might probably get a return more than this 10% little interest rate. However, if you deposit your money in the bank, you will wait this fixed payment 10% only, which is a loss. Also, people tend to borrow from banks in order to invest in some other investment areas, because if they found the interest rate, they pay 12%, which is a loss. Why don't they borrow? They borrow from the bank because this is a minor little interest that they have to pay, so they will invest. This means saving will drop. Nobody deposits his money in the bank in order to get this little amount of return. Also, investment will encourage, because people borrow money from the bank because the interest they pay is too low. So after borrowing, they invest their money, which increases the total investment in the country. However, what will happen if the interest rates goes up? Will you deposit your money in the bank, or you will tend to borrow and previous we have seen when the interest rate drops, the investment will increase and saving will decrease. Okay, what will happen when the demand is low? This will stabilize the inflation. Think of this before the interest rate has increased and the money were with individuals' hands rather than the financial institutions. However, when the financial institutions increase their interest payment, everyone starts to put their money in the financial institutions. That means the money in the hands of each individual drops, which lowers their demand. This time they might have the interest to buy anything. However, the money is not in their pocket. The money is not in their hand, so they couldn't afford it. This time we can say that the demand has fallen. So the price arrow should not remain the same in this way. However, the supply is still the same. This makes the price arrow to shift down. So when the demand decreases, if the supply remains the same, the price of the goods and products will remain down, will decline. When I say the supply here, I'm not talking about the money supply. I'm talking about the supply of goods and services. Now there are different products and services available that's more than the people's demand. The availability of the product and goods is very high. When something becomes more available, it will be very cheap. It will get cheaper and cheaper. But what will happen when the demand declines? What if the supply of goods and services also declines? The arrow shifts in this. So as long as or immediately when the demand or when the interest rate rises, if the supply declines, the price of the goods and services probably might keep constant or might not create that much difference on the price of the products and services. But how about employment? We have said that it's hard for individuals to borrow from the bank because the bank charges 52% interest, which is too much. So if individuals do not borrow, they might not have enough money to invest in some other companies. This will decrease the job opportunities for individuals because as long as companies doesn't borrow, they do not create job opportunities for individuals. So to summarize everything we have seen until now, when the interest rate is low in one country, people will not save because the return is small. People try to invest because investment is preferable. This makes the money supply higher, or the money will be more in the hands of the hands outside the financial institution. This will increase the demand for individuals. The demand for individuals will make the price higher, which creates an inflation. The inflation rate will be higher. However, as long as there is too much investment, the employment opportunity will be higher in that country. The second one is when the interest rate is higher. When the interest rate is higher, people start to save in order to get this higher return in the form of interest rather than investing their money. Also, they do not borrow money to make an investment because they are required a higher interest. This will decrease the total investment in the country. As long as people does not invest, the employment opportunities in the country will decline. However, the money is more in the financial system rather than outside with individual parts. Hence, the supply of the money is lower, which results in the decline of the demand of it, which makes it easier to control inflation, and the inflation will get decline, or the price will fall when the demand of individuals decline. So with this, I want to tell you about the central bank. The central bank will regulate the bank borrowing rate and the bank lending rate. The bank borrowing rate is what the bank pays you when you deposit your money, because the bank is borrowing from you when you deposit your money. In this case, which is 10%, in this case, which is 50%. Also, there is something called the bank lending rate. A bank lending rate is what you pay for the bank when you borrow money from the bank, which is 12% in this case and 52% in this case. So the central bank in each country, tries to control this interest rate, because as long as it doesn't control the interest rate for the purpose of competition, banks might increase their interest payments to attract the depositors. This time, when everyone deposits their money in the bank, the investment in that country or in other things, people do not invest in other things, or in other words, the employment opportunity declines because people just put their money in the bank rather than investing and paying their money to individuals by hiring them. So the central bank regulates interest rate deliberately to maintain a In previous, we have seen when the interest rate drops, the investment will increase and saving will decrease. As a result, the money supply in the country increases, which elevates the demand of individual. So we stopped thinking what will happen when the demand rises. What if the supply and the goods and services the supply of goods and services remains the same? This is the price of commodities when the demand and supply were equal. However, we have said that the demand has increased. Let's look at the scenario when the supply is still the same. When the demand increases, the supply is still in that position. When the demand increases, if the supply does not increase by the same amount, the price of goods and services will spike because people need it. However, the product is not there, it's unavailable. When something is unavailable in life, it will be expensive to get it, so that's why the price will get up. However, if the supply of goods and services increase by the same amount as the demand, following the demand, I don't mean to say the price will increase. This arrow shows you what will happen to the price. This horizontal line indicates it remains the same. However, this line shows you that the price will increase. It's just a direction, not telling you the appropriate amount. No, I'm not talking about that. But when this arrow is up, it's showing that the price is increasing. When this arrow is horizontal, it is showing that the price is still the same and no changes happened on the price. So as what we have seen in the previous, when the demand increases due to higher money supply or lower interest rate, the supply should increase by the same amount. When that happens, the price remains the same, because as long as people are getting what they want without too much effort, and if this when I say supply, it's not about money supply, it's about the supply of goods and services. Think of it as commodities. So if those commodities are available, even if people's demand has increased, if the products are available, it doesn't create that much change in the total price. However, when the people need that products too much and that product is not yet produced to the extent that satisfies their demand, the price will increases, which makes the inflation go up. So when the money supply in individuals' hand increases, it will create an inflation in the country. The other one is employment. So think of yourself as a wealthy man who is building his new enterprise in the city. When the interest rate drops, you will start to borrow from the bank in order to finish that enterprise. Or after you build that company, you will hire individuals in order to work in your company. This will create the employment to go up. So employment will increase when interest rates decrease. However, when interest rates goes up, people will not borrow, because as an individual, for me, it's better to deposit my money and get this 50% return rather than taking and borrowing from the bank and paying 52% interest. Probably the investment I make might not even give me the return that I should pay to the bank, which is 52%. So it's better for me as an individual to put my money here and get this large amount of interest, 50%. However, if I borrow, I should pay this 52%. Probably if I aim to invest it somewhere else, probably I might not get a return which exceeds 52%, and for me it's hard to repay this 52% to the bank as interest payment. This will give us a conclusion: when the interest rate goes up or increases, the investments are unimaginable, because you don't borrow, you don't invest, you do not invest. I'm not saying in order to invest, the only way is just to borrow money. I'm not saying that, but even if you have some amount of money, for you it is better to put the money in the bank and get this amount of return rather than for you to put this money in other investments that are risky and that might not give you a return of 50% like the bank did. So when the interest increases, investment will drop and saving will be encouraged. What will happen when the saving increases as every individual saves their money in the bank, in the financial institution. This makes the money in the financial institution more and high. However, the money on individual hand will not be accumulated like in the previous, which choice will depend on where do you want to invest. If you want to put your money in the bank, you will invest in country which has a higher interest rate that pays you a higher return in the form of interest, because depositing your money in the bank is also one of the investments. If your investment goal is to invest in any other businesses rather than putting your money in the form of deposits, it's better for you to invest your money in a country which has a lower interest rate, because if it has a lower interest rate, you can borrow your money, more money, and invest. You can borrow more money from the bank that is found in a country which pays a lower interest to make additional investments other than depositing your money. So that we have now known how inflation and unemployment might be created, and we know the relation with the money supply and money demand. So that it's better now to look at the government policy, because the government has two types of policies that controls inflation and unemployment indirectly by controlling the money supply in the market. These two policies are called a monetary policy and physical policies. If we know this general truth, if we understand this general truth, when the money supply in the market increases, the demand for goods and services will increase. This impact makes the price to go up, and the more the price of goods and services grow, the inflation rate, or the rate at which the price of goods and services increase, will also elevate. That's how inflation occurs, due to higher money supply in the market. So there should be a way for a government to control this money supply in the market using a fiscal policy. How a fiscal policy works is, it is directly applied by the government rather than by the national bank. A national bank is an agent of the government. However, a national bank applies a monetary policy rather than fiscal policy, and the fiscal policy is applied by the government rather than by the agent of the government, which is the national bank. But why do we concern about these two, employment and inflation rates? Because these two are the main determinants that can show how the company grows and the standard of people is good. Because as an individual in that country, the creation of job opportunity might affect your people's income, because if there are lots of job opportunities in that country, the average income per one person will be higher, because they get the money from their job, from what they are doing. So most of the people in that country will have a higher income per one person if there are too many job opportunities. However, even if they get that income, even if the income per one person is high, if the purchasing power of that income or that money is low, still we cannot say there is a growth in the country, because the money they get from their job will not buy anything. That's why we say controlling employment and inflation is controlling a country's growth or a standard living of individuals. We have seen that when the supply increases, the inflation will increase. However, a government has a fiscal policy to control this money supply in the market. One is by creating budget surplus. Surplus means a revenue in excess of expenditure. A government has a revenue and expenditure. The main revenue for the government is tax. When the government finds out the money supply in the market is high, he might plan to collect this money and reduce this money in the form of tax from the market. However, if the government took this money from the market and expend it back to the market in the form of expenditure, it will have the same effect. However, creating a budget surplus or collecting more money or revenue and expending less might decrease the total money supply in the market, or the total money supply that is in the hands of individuals. As we have seen, when the money supply decreases, the inflation will decrease. So increasing the tax rate is one of the government fiscal policy. Even if this had a positive impact on the inflation reduction, however, it has a negative impact in the job opportunities that are created in the country. Because when individuals are taxed a higher amount, companies are expected to pay most of their profits to the government rather than using it for their own. So if the companies are not taking their profit to themselves, they do not think about hiring employees and creating many different investments, job opportunities for others. Even they might leave the industry as a whole if they do not become encouraged by earning a proper amount of profits they deserve for themselves. So this will decrease the inflation rates, consequently decreases the employment. So when the government decides to collect more than what it needs or plans to spend, at this time the supply of money declines, which lowers the demand, also which lowers the inflation. However, hurting the employment pattern in the country. However, this time it's better to make a tax incentives for some specific companies which have a higher or larger production in the country in order to maintain the supply when the demand grows. The other one is reducing the tax rate. When the government decides to take a lesser amount of taxes than what it really needs. This time the government needs more money, or he wants to expend this money, a lot amount of money, however it collects less from the market. This will inject the money in the market or in the hands of individuals in the form of government expenditure. However, the government will not take back the money from individuals in the form of tax, because it will collect a lesser amount of tax this time. So how can a government gives more than it collects? Because this time we will see a tax is not the only form of or way of collecting revenue for the government. The government can take a lot amount of money, or he can finance its deficit in the form of any other way. If the government doesn't want to collect more money in the form of tax, he can collect or get the money using different options, such as by printing new currencies, by borrowing. These are called deficit financing, because when the revenue is less, the tax revenue is less than the expenditure or the need for the government, this will create a deficit, which is called a budget deficit, and financing this deficit is called a deficit financing. Think of it, what will happen when the government print a new currency just to finance its deficit? This will highly dilute the purchasing power of the currency. Just we look at it further in the next videos, for example, when we see exchange rates or any other topics. However, when the money supply from the start, the money supply in the market was, think of it, a government doesn't have any money. All of the government capital was zero, but the money in the market was only $100, or the money in the country available is $100. Listing the government to $25 in the form of tax. This means the government now has. So when you take 25 of it, it will become $75 remains in the market or in the hands of individuals. This is the government revenue in the form of tax. However, the government wants to spend $50, but it plans only to take or to collect 25 of it. There might be different reasons why the government collects $25 when he wants $50, but let's assume the government took 25 of it only. At this time, government doesn't have enough money what you want to invest or spend. We can say that we have $25 deficit, which is the excess of expenditure above revenue in the form of tax. Okay, what will happen time 25 of it should be financing from elsewhere? This is what we call deficit financing. Let's say the government uses printing currency for to finance its deficit. This means now the government has $50, one that comes from the tax revenue, one by printing the money. So he will spend all of these $50, which means primarily the market have $25 in the country. However, when the government injects this $50 in the country, the total amount of dollars in the market goes from the total was from the start it was 100, but after the currency is printed and expenditures are made, the total amount of money in the market will become 125, because 25 of it are taken and 75 of it are left in the market, and the government brings additional money on this $25 and invests it in the market. The total amount of money in the market will become 125. This will elevate the total amount of currency in the market from 100, which are initially present, to 125. 25 is came in the form of printing the money. This will dilute the purchasing power of the money, because there will not be sufficient enough demand when the market has $100 and when the market has $125. This represents the money is in the hands of individuals. There is too much money present in the hands of individuals, which creates a higher demand that increases inflation. However, when the money is in the hands of individuals, this means individuals might tend to create job opportunities for others because they have the money. When they create job opportunities for others, employment will spike. And when a job opportunity is created for most of the individuals in the country, and individuals are earning income, however the income they get is highly affected by the inflation, or the money they get from their employers might not be sufficient enough to cover the inflation. We have said that this is directly implemented by the government. However, there is something called the government policy is a monetary policy. A monetary policy is not directly made by the government, but the agent of the government, which is called a central bank, will apply this monetary. It's all about controlling the money supply in the market, which affects the inflation and the employment. We have talked one of the monetary policies that is increasing or decreasing interest rates. We have seen how much interest rates affect the money supply in the market. I'll put the link in the description, or you might find the video here that talks about how inflation rates affect the employment and employment opportunities and inflation. So inflation is set by a central bank. A central bank is called a banker of banks. So this bank has a power to set interest rates. For example, he might make a rule. He might set a rule saying that the interest rates or bank borrowing rate should not exceed 20% and should not be lower than 18%. This means all of these banks cannot pay an interest which is lower than 18%, and they cannot pay an interest which is more than 20%. For example, this bank cannot pay 21% of interest for its customers to make a deposit in the bank, because this can highly affect the inflation and employment opportunities in the country. Probably it might not highly affect employment opportunities, however, it will affect highly the inflation rate. As long as it affects the inflation rate, it's better to make a rule or to implement a rule that affects the inflation rate in the country. Also, about the bank lending rate, the central bank might decide a bank lending rate from 25 to 27. This means an individual who borrowed from the bank has the right not to pay more than 27%. For example, if I borrow from the money from one of these banks, let's say this bank, and if it charges me 28%, I have a right to say no. And it's not possible for the bank to charge me 24%, because the minimum amount of interest rate the bank lending rate is set by the central bank from 25 to 27%. Manipulating interest rate is one of the monetary policy. However, there are a lot others. We have seen in detail in the previous videos. However, just to revise the effect, when the central bank sets the interest rates, the market interest rate high, the inflation will drop, people tend to save and do not borrow. This will result in accumulated cash in the financial system. Also, this will decrease the demand, which lowers the inflation, but this will decrease the job opportunities or employment, because if the demand is lower, this means individuals doesn't have enough money to hire employees, because the money supply in the market is minimized due to the higher interest. For more, you can click here, or the link is in the description, that talks about the interest rate effect, the inflation and employment in detail. Other monetary policy that is applied by the central bank is to control the bank reserve requirement. there is something called the reserve ratio. So the central bank might apply a contractual or expansionary monetary policy. Contractual is, as the name indicates, to contract or to reduce the money in the market to the financial system. Expansionary means to inject the money in the market or individual's hand rather than in the financial system. As we know, lowering the interest rates, the market rates, makes the people to borrow, which is one of expansionary monetary policy, setting the interest rate low. However, setting the interest rate, the market interest rate high is a contractual monetary policy, because people will deposit their money and they do not afford the interest payment if they want to borrow. This will elevate the money in the financial system high, more, and the money in individuals' hands less. In other words, the money will be pulled out or contracted to the financial system rather than individual hands. This is how interest rates affect the inflation and employment opportunities. However, when you talk about a reserve, there is something called a reserve. There is something called a reserve. Reserve means what individual banks pays to the central bank. Every bank puts their reserve money into their central bank's account 2 times. One is when they are formed. So this will happen 2 times. One is when they are established from their working capital or from their capital. For example, let's assume on the year 1, this bank has established and prepares $100 to work or to start its business. However, the central bank will take some amount of money from this $100 or the beginning balance of this bank. The amount this Federal Reserve Bank took from the beginning balance is called reserve, and this reserve is stated in terms of some amount of percentage. For example, if it is 10%, this means the bank will pay $10 to this reserve or central bank, and it can operate using this $90 for its operation, leaving $10 in the reserve bank. Let's say this happens on the year 1. So if the reserve requirement is 10%, all of the banks will pay 10% of their beginning balance. For example, if this bank has $200, he will pay 10% of it. That means $20 will be deposited in the central bank, and $180 of it will remain for its operation as a beginning balance to work on it. So from their capitals, all of the banks should put some amount of reserve to the central bank, 10% on the year 1. However, when they reach year 2, they might have some amount of profit. Also from that profit, they should deposit some amount of reserve to the central bank, the amount that is stated in the reserve requirement ratio. For example, if this bank has a profit of $100, this means he has $90 at the beginning and had a profit of $100 at the end. From this $100, which is the profit, the central bank reserve requirement, let me take it as 10%. This means also from the profits, he can only take a profit of $90, leaving $10 for the reserve bank. In total, the bank has reserved in his account, which is on his account $20 at the end. Also, other accounts of banks might be affected depending on their profit and loss at the end. So as an example, we took 10% here as a reserve requirement ratio. What if this 10% increases to 50%? Is it possible for this to bring an impact on inflation and reserve requirement ratio is higher because this ratio is set by central bank who is an agent for the government. That's why it is included under the government policy. We have seen that the government policy has two types of policies, that is fiscal policy, which we have seen in the previous, and the monetary policy. And the monetary policy is applied by the central bank, where the central bank decides on the rate of interest rate and reserve requirement ratio. So now we are looking at how the reserve requirement that is set by the central bank affects the inflation and employment. If the bank's reserve is higher, whether in their profit or their initial capital, it is higher. To understand this, we should know how the banks lend their money. As we know, the banks took individuals' money in the form of deposits and lenders for individuals who want that money or for the borrowers. However, if the bank collected some amount of deposit, however, the central bank took most of the deposits in the form of reserve, this bank will not have enough money to borrow to its customers. For example, in a situation where the reserve is more than 50%. This will have a great effect on the money supply in the market, because as long as people do not borrow from the bank, the money supply in the market will not grow or it will decline. So when the money supply declines, the demand for goods and services will also decline. This will affect the overall inflation, because when the demand falls, inflation will decline. As long as people do not borrow money and work, they will not create different companies, they will not create different job opportunities for others. They will not have enough money to pay for their employees, because the total money supply in the market is very low, or the money is not in the hands of individuals. Hence, this has a good effect by reducing inflation. However, if we see the job opportunities or the total employment that will be created in that country, this has a negative effect on the job opportunities that are created in that country. But what will happen when the reserve requirement is too low, like 10%? This time, the banks will collect in the form of deposit too much amount of money. However, they will not reserve most of it to the central bank. This means they have the ability to lend to different borrowers or to different customers. At this time, people borrow from the banks in order to start up their business or to work on it. This will, as more and more people borrow from the bank, the total money supply in the market will increase, which makes the money in the hands of individuals. That creates a higher demand for goods, products and services. This will make the price for goods and products will higher, which increase inflation. However, when people borrow money from banks, the job opportunity will expand. So let me take 1 minute and summarize all of the impact of government policy on interest rate and inflation. A government policy is divided into monetary policy and fiscal policy. Fiscal policy is about controlling the tax revenue and expenditure of the government. When the tax collected is higher than the spending of the government, this will decrease the total money supply in the market, because money is collected in the form of tax, which lowers the demand and reduce inflation, but reduce employment rate, because people are being taxed higher amount. When the government expenditure is more than its revenue collected in the form of tax, the government needs additional money to finance its deficit, and when it spends all of that money, the total money supply in the market will skyrocket, which increases the demand and inflation. However, it's not collecting higher amount of tax. Incentive to work individuals will rise, which increases the employment, even if it creates higher inflation. This is a monetary policy, fiscal policy. And a monetary policy is applied by the central bank by increasing interest rate and the reserve requirement. When the interest rate increases, people deposit their money, which reduces the money supply, also reduces the demand and the inflation. When the interest is too low, however, people deposited their money rather than investing. As long as there is no diversified investment in the country, job opportunities will not be there too. When the interest rate is rise, I've talked about when the interest rate rises. Now let's talk about when the interest rate falls. This time people try to borrow, increase the money supply, demand and inflation, but decreases employment opportunities. For the monetary policy, it's all what we have seen in this video. The other one is exchange rates and okay, we'll talk more about this when we talk about the central bank. The other one is better deposits. In one country, government might borrow because when the revenue the government gets might be lesser than the expenditures or the money you want to spend. This time the government borrows to finance its deficits. This is the budget deficit. Current account deficit means the difference between import and export. This highly affects the exchange rate or the strength of currency of that country. To understand most of these concepts around here, which is saying that current account deficit, exchange rate, we should understand this thing, and after that we look at the government policy and finish the economic analysis. Whichever country you are, Now I want you to assume as this Indian man. So there are two things which are called a local currency and a foreign currency. When you take yourself as this Indian man, other currencies, for Indian, rupee is their currency. So a rupee is a local currency. However, any currency that is not lot of currencies other than rupee, and all of them are a foreign currency, because there are a lot of currencies other than rupee, and all of them are a foreign currency for this person. So if you understand what a local currency and foreign currency is, it's time to know what a direct exchange rate and indirect exchange rate are. You can easily understand what a direct exchange rate and indirect exchange rate is just by remembering these pictures only. Expressing a foreign currency in terms of a local currency is called a direct exchange rate. However, expressing a local currency in terms of a foreign currency is called an indirect exchange rate. For example, think of your local currency as rupee. We know that there are a lot of foreign currencies, but let me take one which is a foreign currency of Australian dollar. So if you ask how much is $1 in terms of rupee, you are talking about direct exchange rate. However, if you are asking how much is 1 rupee in terms of Australian dollar, you are talking about indirect exchange rate. So direct exchange rate is expressing the foreign currency in terms of a local currency, and indirect exchange rate is expressing a local currency in terms of foreign currency. So what will happen? The direct exchange rate, one Australian dollar can buy to a lot of local currencies or Indian rupees. So when you say the direct exchange rate has increased, we are talking that the local currency we had is getting weak. An increase in direct exchange rates is the same with decreasing in the indirect exchange rate. Concern about or focus only about the direct exchange rate. So what will happen when the direct exchange rate decreases? This means one Australian dollar can buy less amount of Indian rupees. This means the local currency is becoming higher, stronger, because you cannot buy too much amount of Indian rupees using just only $1 of Australian. Also, the decrease in direct exchange rates is the same with the increase with or increasing with indirect exchange rate. However, still don't focus on this, just focus on that. Talk about the central bank. The other one is better deposits. In one country, government might borrow because when the revenue the government gets might be lesser than the expenditures or the money you want to spend. This time the government borrows to finance its deficits. This is the budget deficit. Current account deficit means the difference between import and export. This highly affects the exchange rate or the strength of currency of that country. To understand most of these concepts around here, which current account deficit, exchange rate. Most of the time, this will be affected by the money supply, the currency supplied and demand. If we ask what is the reason behind the strengthening and weakening of local currency, because we have seen that when the direct exchange rate decreases, it means the India's rupee is getting stronger, the local currency is getting stronger. But if you ask what makes it strong, is the demand for that currency. Most of the time the rule of economics are not obsolete, but holding other factors constant, the supply of the currency might weaken or strengthen the local currency. For example, think of from the India's perspective, think of just for all of the example, think of your local currency as rupee. Imagine in India, this much percent of the country is trading with the Australian dollar. However, there are small amount of rupee in the hands of individual. I mean, in the financial institution or wherever you call it, just in that country. At this time, the demand for rupee will increase. However, there is too much amount of Australian dollar. The supply of the dollar is too much. People do not want it because there are plenty of dollar. The country doesn't want a dollar anymore because she have a lot. However, the country demands a rupee more. This results in a strengthening of the local currency because when the demand for that currency increases, people need more and the currency will become stronger. What does it mean the currency is stronger? The direct exchange rate is already fallen. Or when the country's currency is stronger, the direct exchange rate will decrease. This means one Australian dollar buy a few rupees only, not too much. If you see from the perspective of, just don't focus on this, but if you see from the perspective of indirect exchange rate, when you say our local currency has increased, I mean it's getting strong. When we say that our local currency is strong, we are saying that the indirect exchange rate is increasing. This means one Indian dollar can buy a lot of Australian dollars. This means one Indian rupee is stronger than the Australian dollar. What if India doesn't have too much amount of Australian dollar? When this happens, the local currency of India is getting weak because there are too much amount of rupees. The country doesn't need this anymore. Doesn't need too much amount of rupees or additional rupees because there is excess of it. However, hence there is small amount of dollar in the country. People need dollar. People need the dollar. This means the local currency of rupee or India is getting weak as the amount of dollar accumulated in India decreases. What do we mean when the local currency is weak? Is getting weak. We are saying that the direct exchange rate is increasing, which means $1 can buy a lot of rupees. If $1 can buy a lot of rupees, this means $1 is strong than these rupees. Just don't focus again about the second, but also indirect exchange rate is decreasing. This means one Indian dollar is weak. The amount of dollar these rupees buy is decreasing. When the direct exchange rate or the amount of rupees this dollar bought increase, the amount of dollar this rupees bought decreases. It's a way of explanation, two different ways of explanation, but which have the same meaning. So to conclude, one thing you should know is when the supply of the local currency increases, the demand for this local currency will decline eventually, which makes the currency weaker. And when the currency is getting weaker, when the local currency is weaker, it cannot buy too much amount of foreign currency, which is shown in the form of declining in indirect exchange rate or increasing increasing indirect exchange rate. However, when the supply of this local currency is low, that local currency is getting stronger, which is so if we analyze all of this, we have successfully analyzed the economy of a country. After finishing that as a fundamental analysis, we should analyze the industry also. The industry, for example, after choosing one country which has a positive result on all of these variables, or which we might find it better, we have to start to analyze the industries in that country to to invest which industry is beneficial. For example, if
So ይሄ ብዙ እየስፕራይድ ነገር አለ። ሶኬት ላለ ማለት ከቦት ነገር ነው።
different investments or different industries that are found in Ethiopia. For example, analyzing what raw materials that industry, the labor demand of the industry. Don't concern about it. Just it's enough if you know the concept. What the industry analysis is. This is not a basic concept. Their product line, the performance of that industry, the earning performance, the nature of demand, labor condition, attitude of the government towards that specific industry. We have to analyze all of this as a fundamental analysis. And the industry might be at a pioneering stage, expansion or growth stage, maturity or stagnation, and decline stage. This is not concerning. It's not more related to finance. But for general knowledge, if you want to know pioneering stages, the industries that are found at the start. The expansion is the industry which is growing. The industry which is found in the maturity stages, the one who have finished or this grows and will not grow anymore, probably might decline. And for the industries which are found in the declining stage, we can avoid our investment in such kind of industries. We can also analyze different segment attractiveness, but these are not as much important as a finance student. The other one is, or the last step is EIC approach. A company, sorry for the spellings, I couldn't edit the spellings. So in a company analysis, we should have to see the marketing policy, the accounting policy, the profitability of that company. Because now we have selected the industries, specific industries that we want to invest in. We should look at different companies that are found in that industry, that has separate or different marketing policy, accounting policy, that has different profitability, capital structure and dividend policy. We will, if you want to know more about capital structure and dividend policy, I have made a separate video on that. You can find the link in the description or here. Also, the ability of the management to handle different workers that might also make us to choose that specific company or not to choose it from other companies that are found in that industry. In the company analysis, there is also a ratio analysis that will be made in specific or different countries and companies, which has a ratio, liquidity ratio, leverage, turnover, profitability. Also, not only ratio analysis, there is also a trend analysis. I will make separate video about that. You can get the link in the description or here in our financial management section. So now that we have completely finished the topic about fundamental analysis from the two approaches. From the start, we have talked about there are two types of investors. One is the fundamental analysis, the other one is technical analysis, or you might perform both of them. However, now we have seen that the fundamental analysis contains EIC approach or CIE approach. EIC means economy, industry, and company. I've talked a lot of things about analyzing how the economy for one country is analyzed, and we have talked about industry and company analysis. Probably you might start from the company rather than starting from the economy of the whole country. If you analyze the company and analyze the industry where that company is present in the different industries, and if you analyze the economic pattern or the macroeconomy of the country where that company is situated using the backward process, it is called CIE approach or company industry economy approach rather than economy industry company approach, what we have seen the previous. So we do not look about CIE approach because it has the same concept, just the pattern will differ. One is from the economy to from the country's economy to the individual company. One is from the individual companies to the overall economy of the country. Both of them are the approaches that are used in the fundamental analysis. In technical analysis, rather than looking the overall economy or studying the share price fluctuation, if the technical analysis found in previous, if the company has a good history on the price of its shares, just looking the share price chart in the previous, if the company share price is found out to be increasing in the past, they assume or predict in the price of the shares will increase. So they will select a company which has a higher or a good history of share price. This is more likely linked to speculators. Most of the time, speculators makes a technical analysis because they want to buy and sell the shares. They are more benefited from price fluctuations so it's better for them to make or to undergo technical analysis. However, pure investors mostly consider a fundamental analysis because they want to last longer in the company by holding the company's share. Don't forget, from the start we were talking about a financial regulation, and in financial regulation there is a regulatory body and the one who are being regulated. So different financial market participants are regulated by the regulatory bodies, so we have to know about all of them participants who will participate in a financial market. From that we have started to talk about pure investors and speculators. Just to understand this concept and many more other concepts, we have looked at the fundamentals in technical analysis, how fundamental in technical analysis is made. That will make it easy to understand more about pure investors and how speculators work. The other financial market participants are retail investors, who are individual investors. The other is institutional investors. A retirement scheme, which invests in less risk-free investments, because retirement schemes are like a pension funds. They will pay you a pension after you retire, so they should return the money they took from you. So if they involve in high-risk investments, they might lose the money, and it's advisable, not only advisable, it's must for a retirement scheme to invest in a less risky investments like treasury bills and any other risk-free investment. The other participant is endowment fund. This is any organization when that organization has an idle fund. It may not necessarily be established to invest, or probably the main operation of that company may not be investing or involving in any other financial activities. But you can take any organization, for example, if it is a school, and if that school has an idle cash, it can store that money, that idle cash, in the endowment fund and invests that money. So when organizations has an idle cash, they can save, or they can establish, or they can form an endowment fund by themselves. So these parties will also involve in the. This is not an organization, but the government itself has an idle or surplus cash. For example, when there, as we have seen in the budget surplus, when the revenue collected is more than what the government spent or planned to spend, the government will have an idle cash or surplus fund, and that fund might be invested using a government sovereign wealth fund. So the government sovereign wealth fund is one of the financial market participants. Investment companies, we have talked a lot about this. There is a fund manager. This might be an institution, however, this might be an individual person. We have talked about this also in the previous videos. Sorry for the spelling, my keyboard now is not working properly, that's why. The stockbrokers, we have talked about secondary market and primary market. So on the secondary market, one investor might buy a security and sell it for the other investor. The stockbrokers work in the secondary market, who buy and sells. The one who communicates the buyer with the seller on the secondary market. The stock dealers are called, in other words, they are called the market makers. They buy and sell the security rather than connecting the buyers and the sellers on the secondary market. These are also operations on the secondary market. The stock traders, these are the same with the stock dealers. However, the stock dealers works 24/7 as their main job. However, stock traders are the one who considers this job as a part-time job in addition to their own job. If you are a teacher and working in one school, however, once in time, if you buy and sell a stock or a security, you are a stock trader. However, if your work is 24/7 to buy and sell securities on the secondary market, not as your part-time job, but as your regular business, you are called as a stock dealer rather than a stock trader. Insurance company, we know all about insurance companies. It's easy, and we know that insurance companies are a financial market participant because they work using a contractual agreements. Custodian bank, we have talked about this. A custodian bank is the one who looked up different commodities of individuals to safekeep their custodies. These products might be other than cash, which are real assets. We have talked about a real asset in a financial asset. So if they save or keep or lock or safeguard different individuals' commodities or real assets, this kind of banks are called a custodian bank. International banks, these are banks that operate in a global level, like Swiss Bank. We have talked about credit raters, which are Moody's, Standard, and Fitch. These are all a financial market participant. We have talked more about fundamental analysis and technical analysis. So understanding all of those concepts might make our job easier in understanding the future lessons. So now we know about who financial market participants are. It's time to know who will regulate and who will be regulated. We know that a central bank is a regulatory body, and we have talked a lot about it, how it can use as an agent of a government to stabilize interest, to stabilize inflation and employment or job opportunities by fixing the amount of reserve ratio and interest rates. It is called a custodian of the government, a banker of banks. Central bank has different name in different countries, but it's not necessary to know each. In some countries it's called Federal Reserve Bank, in some countries it's National Bank. But understand for and central bank is the custodian of the government. That means the money of the government is deposited in the custodian for the government. And it's a banker of because it's a different which is both in the profit or initial paid up capital. Sometimes this central bank gives an overnight loan with a minor interest to different banks when they don't have enough money to pay for the depositors. But one thing we do not have talked about is why central bank collects all of these reserves from different banks. Because banks are financial institutions that has a higher impact in the overall financial performance of the company. So if one bank fails, it has a huge impact or consequence in the economy of the company. So protecting different banks is must. And that needs a financial regulation which is performed by central bank. If the central bank doesn't take a reserve from different banks, probably if the financial crisis happens, the banks might not have enough money to pay for the depositors. This will not only affect the bank, however, it will also affect any depositors that are in this financial crisis. Central banks lend the money that they took from different banks for reserve, so people or customers or depositors will not suffer from financial crisis. This will increase the confidence for each individual or customer rather than holding it on their pocket or their home or in piggy bank or any other boxes they found in their home. Also initiates different people to save in the bank. This is the main aim or agenda of taking different reserves from banks, different amount of reserves from banks, depending on their initial paid up capital and profit. Also, sometimes if the banks has a higher non-performing loan is the money that is not collected or remain uncollectible after lending it from different customers. So when that customer cannot pay the money back to the bank, the money is called a non-performing loan. The loan given back when one bank has too much amount of non-performing loan, a central bank might limit or restrict that bank from lending money for some period of time. Because if the bank fails, not only the bank but the different depositors and customers in that bank will also be affected. An obligation for the central bank to protect the financial system as a whole and protect individual depositors from. That's why central bank highly regulates central bank. And central bank is not a bank of individuals, it's a government. We call it also as an agent of a government. Also, when it has an obligation to set up capital, interest rate, market interest rate, limited and money supply, money demand. Also, when different monies are disposed, it can print equal amount of money without affecting the total money supply present in the country. When different monies are disposed, rather than throwing it away, you might print equal amount of new monies to change the new for the old one. Can also affect, can also have the power, to affect different advisor of the government in different financial situations. It's a holder or it's a holder of government money or an angel that sometimes it determines the foreign exchange price. If the company has some expensive goods in the form of commodity, not in the financial asset but in real estate, goods that are essential for the country, this fund can be used as a custody for this kind of goods holding the country's commodities. So it works on devaluation and revaluation of currency. Devaluation means to increase devaluation to decrease or to devaluate the currency power. Devaluation means to increase the power of the currency. It makes the government international payments on behalf of the government. It gives loans for the government. I mean, you are talking about the regulatory bodies. One of the regulatory bodies is central bank. We have talked how central bank controls or how the monetary policy of central bank works. This shows us how central bank regulates the financial system by setting interest rates, by setting reserve ratio and using an open market operation. The other regulators might be Security Exchange Authority. This is an organization established just to create information symmetry. To take action on security exchange on the secondary, just to control the security exchange market that established to control it. So Security Exchange Authority is also one of the regulatory bodies that regulates the financial system. So we have seen the financial market participants and regulatory bodies. It means we have finished the financial market, financial assets, financial regulations, also financial institutions, which is we have already understood all of the concepts related to the financial system. So to conclude, let's look at what is the purpose of or the advantage of having a good financial system. It has a saving transition, which means people deposit their money using a financial institution if there is appropriate and proper financial system. Liquidity function, this means shares or different bonds or different securities can be converted to cash. If there is a secondary market, for example, credit function, people can borrow. Payment function, for example, banks might pay from their deposit, or if they fail to, they might take from the financial institutions. Also, not only that, it's easier to make a payment if there is a proper and readily available financial system. For example, different electronic payments. It's easier for one to send money even without physical contact. The other one is protection function applied by different regulatory bodies that protect individual investors and depositors. Insurance companies, one of the components of financial in the form of financial institutions. Insurance company protects different people's, not only their money, but there is also a life insurance, just to name a few. Policy function, different financial regulation can help to prevent different to prevent financial crisis. It's the function of the value of financial system. With this, we have finished our course for listening. And that is a financial regulation which is formed by central bank. The central bank doesn't take a reserve from different banks. Probably if the financial crisis happens, the banks might not have enough money to pay for their depositors. This